In this short video tutorial, we're going to look at an introduction to ratio analysis. We're going to look at our introduction under 4 headings. First of all, we look at profitability ratios, where we look at 3 different ratios. Then we look at liquidity ratios, we'll examine 2 ratios. Then we move on to activity, or sometimes referred to as efficiency ratios. We look at a further 3 ratios. And then finally, we look at gearing, where we look at just 1 ratio. First of all, we start off by talking about why would we use ratios. We would use ratios to provide a framework for our analysis. We'd use it as a comparison to previous years. We could use ratios to try and identify trends. We could try and identify areas of concern, such as low liquidity or low or falling profitability. We could use it as targets. We can set targets for a target return on investment. And then we can use it as a comparison to other similar organizations. Next thing we look at is the limitations of ratio analysis. Firstly, the problem is that accounting statements present a limited picture. Another point is that accounting policies can distort any inter-firm comparisons and trend analysis. Another issue is that accounting statements are historical. They're telling us what has happened in the past. Also, ratios can be misleading if used in isolation. So you should always try to use ratios with additional data or information. The effects of inflation are ignored, and also the year-end figures that are in the financial statements may not be representative of the whole year. Now what we'll do is we'll have a look at the different ratios, and we'll start off with profitability. So under profitability, we have a gross profit ratio. And the gross profit ratio is gross profit divided by sales multiplied by 100. So in other words, it's expressed as a percentage. Then we'd have the net profit ratio, which is the net profit divided by sales multiplied by 100. And then the third one we said we'd look at is the return on capital employed, which is net profit divided by capital employed multiplied by 100. And return on capital employed is the owner's capital plus long-term loans. Now, in this sort of question, or these type of analysis, what we're trying to do is we're trying to measure how successfully is the company trading. So in terms of profitability, what sort of profit is making on sales, what sort of profit is making in terms of the amount of money that's been invested in the business. Next area we're going to look at is the area of liquidity. Now, under liquidity, we have 2 ratios. One ratio is the current ratio, and the current ratio is current assets divided by current liabilities, and this is expressed as a proportion to 1. So it could be something like 2 to 1, which means that there is €2 worth of current assets for every €1 worth of current liabilities. An extension of this is the asset test ratio. And the asset test ratio is the current assets less the inventory divided by the current liabilities. So in other words, we're talking about the more liquid current assets. We remove inventory from the listing, and with the liquid current assets divided by current liabilities. Again, it's expressed as a proportion, something to 1. So you might have something like a 1-to-1 ratio. Now what we're looking at here is how well equipped is the business to pay its way? E.g., does it have enough cash to pay its current liabilities, i.e. its creditors? The third area we have is the activity or the efficiency ratios. Now, under these we have 3 ratios. The inventory days. So inventory divided by cost of sales multiplied by 365. So you notice 365, so we're talking about the days. How many days of stock or inventory do we have on the premises or in the business? 365 being the number of days in the year. The accounts receivable days. How long is it taking our customers to pay us? So this is the accounts receivable divided by sales multiplied by 365. And then we have the accounts payable. How long is it taking us to pay our suppliers? So it'll be the accounts payable divided by the purchases. So just remember that the accounts receivable, we sell goods to people, they owe us the money. how long is it taking them to pay us? It was accounts receivable and sales. And the accounts payable, we purchase goods from people. How long is it taking us to pay them? So it's account payable and purchases. Now, what are we trying to measure here? Well, how is the working capital being managed? So, working capital in the area of the whole current assets and current liabilities area. And how are the inventory, the accounts receivable and accounts payable being managed? So particularly those three areas. And then the final one we're going to look at is the area of gearing. Now, under the heading of gearing, we have one ratio, debt to equity ratio. And this is the long-term debt divided by equity multiplied by 100. And equity is ordinary share capital plus reserves. So here we're trying to measure is, what is the level of long-term debt to share capital, i.e. equity, and how does it affect the performance or the risk of the business? Okay, that's just a quick introduction to ratio analysis. So we will just finish it off there. Thank you very much for listening.